Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get right into it. The source document we're breaking down today is a really interesting one, and it's titled Insights, AI Revolution versus Bubble Burst, the 2026 Tech Giant Verdict.
This video presents a direct informational narration of the source document.
And just a quick, important reminder, all of this content is for informational purposes only and is not investment advice. You should always conduct your own independent research.
So here's what we've got on tap for this explainer. We'll kick things off with the big picture, the macro backdrop for 2026. Then we'll get into the why behind all the massive spending. From there, we'll look at the potential bubble risks and really dig into why 2026 is being called the verification year. After that, we'll talk about what this means for valuations and the market as a whole, and we'll wrap it all up with a conclusion and some key things you'll want to keep an eye on.
Okay, let's jump into our first section, the 2026 macro backdrop. The source document calls this a black swan warning for anyone invested in AI. And really, what it's all about is this massive, kind of brutal shift that's happening. We're moving away from what the source calls the AI narrative era, the hype and the stories, and into the financial verification era, where the numbers have to prove it.
And believe me, the stakes here are, well, they're about as high as they can get. The source is basically saying that 2026 is the moment of truth. It's the year we find out if AI is the real deal, the next industrial revolution, or if it's, and this is a direct quote, the largest financial bubble in human history.
So you have to ask, what's behind this pressure cooker of a moment? Well, it's really four big things coming together at once. For starters, investors are just done with the stories. Their patience for narratives has run out. They want to see cold, hard numbers. At the same time, the big tech companies have completely changed their business model. They've gone from being light asset software companies to heavy asset builders of massive infrastructure. And they're making this huge bet in a really shaky global economy where you've got potential treasury shocks or energy crises lurking around the corner. Put it all together, and the biggest threat is that all this spending just sucks the cash out of the system. And if the payoff doesn't come, well, it could trigger a really sharp systemic crisis.
Okay, that brings us to our second section, the strategic CapEx buildout. I mean, given the huge risks we just talked about, you have to wonder, why are these companies pouring hundreds of billions of dollars into this? So let's unpack the strategy behind all this massive spending, or CapEx.
Yeah, this isn't just about throwing money at a wall and seeing what sticks. The source calls this a make-or-break battle to basically own the entire AI ecosystem, and they're betting on 5 key ways to make their money back. First up, renting out their computing power through the cloud. That's growing at 30 to 50% thanks to AI. Second, they can charge more for AI-powered products. Things like smarter office tools or better ads. Third, they can use AI to make their own companies way more efficient, replacing some jobs and supercharging others. Fourth is the huge global prize. AI is expected to add almost $3 trillion to the world's economy by 2028. And finally, there's the pull-through effect. All their spending is what keeps the entire supply chain, everyone from NVIDIA to TSMC, in business. All right, Section 3, potential bubble risks. Because with all this incredible spending comes a massive sunk cost risk. The document uses a great analogy. It's like a high-stakes poker game. These companies have pushed so much money into the pot already that they feel like they have to keep betting bigger, even if they're not sure the cards will fall their way, or if the tech is even ready for prime time.
The analysis points to 3 main dangers here. First, a serious cash crisis. We're talking about a real possibility that the free cash flow for these tech giants could just plummet by as much as 90% in 2026. Second, what the source calls a double squeeze from energy. The power needed for data centers is about to double, but the companies have pretty much promised not to pass those costs on to us. So where does that hit come from? Straight out of their profits. And third, there's the tech itself. If AI hits a wall and can't get past its current limitations, then all this incredibly expensive infrastructure just becomes a giant, useless paperweight, a sunk cost with no return.
And that leads us right into the heart of this whole analysis. Section 4, the 2026 verification year. This is it. This is the year when all that spending hits its absolute peak, and the pressure to show that it was all worth it becomes, well, non-negotiable.
It's honestly hard to wrap your head around the amount of money we're talking about. For 2026 alone, the 4 big tech companies we're looking at, their combined capital spending is projected to hit $650 billion. That's just for 1 year.
And this is how that financial pressure breaks down by company. Take a look at Amazon.
They're spending up to $200 billion, and there's a serious risk their free cash flow actually goes negative. Then you've got Google and Meta, both looking at a potential 90% drop in their free cash flow. Microsoft seems to be in the best shape, relatively speaking. Theirs is projected to drop by a much more manageable 28%, making them the most resilient of the bunch.
So the source paints a really clear timeline for us. Right now, in 2024 and 2025, we're in the investment phase. This is where we see the cash flow starting to drop. That all builds up to 2026, the peak pressure year, the make-or-break moment. And only the companies that get through that test successfully will graduate to the next phase in 2027 and 2028, the inflection and expansion phase. That's where the winners get to cash in on the huge AI prize.
So what's the magic number? What's the goal line they have to cross? Well, according to this research, for these companies to just break even on all the spending, to cover the cost of the hardware, the crazy electricity bills, everything, the revenue they make from AI has to make up more than 25% of their total revenue. That's the critical threshold.
Okay, on to Section 5, Valuation and Systemic Risk. This is the big what if. What happens if they don't hit that target in 2026? And let me tell you, the document is incredibly blunt about this. It says that if those earnings reports from the second half of 2026 don't show a real return on all this AI spending, the entire story that the market has bought into will flip instantly. It goes from being a, quote, growth fantasy to a, quote, super horror story.
So what does that horror story actually look like in practice? A total valuation reset. If the whole AI growth story falls apart, the market would probably snap back to a much more conservative way of valuing these companies, about 20 times their earnings. But here's the key. In that world, a 20 PE isn't a floor for the stock price, it's a hard ceiling. So you'd see Microsoft capped at around $380 a share, and Amazon would be stuck down at $185.
And this is where the danger spreads to the entire market. The problem wouldn't just stop with these four companies. If even one of them suddenly cuts their spending, it would set off a domino effect, a chain reaction collapse through the whole supply chain. Companies like NVIDIA and TSMC would suddenly have no orders, creating this giant vacuum. And that's how you get a real systemic crash. Okay, let's pull all these threads together in our final section, number 6, Conclusion and Key Indicators. Think of this as the scorecard, a way to keep track of how this high-stakes drama is playing out. So, based on all this analysis, the source gives us a pretty clear ranking of the companies by their financial health and risk. At the top, as the most resilient, you have Microsoft. They seem to have the best ability to actually make money from AI. In the middle, you have Google. And then in the highest risk category, you find Amazon and Meta, mostly because their cash flow is in real danger of going into the red. And this last table really is the final report card. It shows you exactly how far each company has to go. It's the gap between where their AI revenue is now and where it needs to be to break even. You can see Microsoft has the smallest gap to close, just 11%. Google's is a bit bigger at 15%. But the real pressure is on Meta, with a 20% gap, and especially on Amazon. They have the biggest hill to climb at 25%.
So what's the big takeaway? The source offers a final, very disciplined strategy. Watch the earnings reports from the second quarter through the fourth quarter of 2026 very closely. If you see any sign that AI revenue growth is stalling out, that should be treated as a major warning sign, a sell signal for a potential systemic event. Because right now, the entire premium in the stock market is built on one single bet, that 2026 will prove this whole AI investment was worth it. And the analysis leaves us with one haunting question. What happens if that bet is wrong?